Fraud in banks is a big business, and a large bank fraud losses can amount to as much as $100 million every year. And this ignores the cost associated with those hundreds of fraud analysts and investigators whose job it is to make sense of and document and more deeply investigate the potentially fraudulent transactions that have been detected. Fraud costs also include the damage that fraud causes to the relationship with the regulator and to the bank's own end customers, something that no bank these days can afford to suffer. Fraud is highly complex too. Theft, fraud, embezzlement, anti-money laundering, security scams, these all operate increasingly in an interconnected way. They operate across channel, they operate across products, across business units, and the bank's got to deal with them in the same way. Fraud is also highly time sensitive. Just as quickly as new technologies come into place to enable banks to identify fraudsters and fraudulent transactions, the same technologies are put in place to take advantage of loopholes in the bank's architecture and the bank's systems. In short, it ends up being a never-ending battle, a battle that frankly banks simply can't afford to lose. It should be no surprise, therefore, that unlike virtually every other functional department within the bank post-crisis, financial crime is one of the few that's seen its budgets actually increase over the last few years, typical increases amounting to as much as 60% year on year. What are they spending that money on? Well, typically they're worrying about three major areas. More predictive analytics, faster transaction screening, and deeper investigative capabilities within the institution. Now these requirements are really replicated across products, channels, business areas, and that very replication implies a redundancy of effort and a value that can be extracted by the forward-thinking bank. It also implies a weakness that can be exploited by the smart fraudster if they want to understand what part of the institution has got the greatest opportunity for attack. This has not been lost on the regulator, of course. Regulators are putting immense pressure on board members and senior executives to make sure that the institutions that they regulate are taking an enterprise and holistic view of financial crime. Making sure that they take a complete view means understanding the full context of the bank's own employees, their customers, their transactions. Very hard to do. Very difficult to get that complete view. Fortunately, IBM's portfolio is well placed to deal with this problem. Our portfolio of information governance, big data, advanced analytics really helps the institutions manage exactly this challenge. Based on our experience with banks across the world, these technologies really enable potentially tens of millions of dollars of savings in terms of reduced frauds. And this is largely driven by a couple of key areas: faster screening, unstructured data as part of the screening process, better investigations. These may lead to as much as a 70% reduction in the number of false positives identified by the predictive system. It may lead to a return on investment measured in the months rather than in the years. The case for big data in fraud detection, prevention, investigation, in my view, is clear and compelling. Thank you.